Hello friends, I am VP Sharma, currently working with Godiji General Insurance Company as mentor property and underwriting. Prior to this, I was working with Bajaj Allianz General Insurance Company and I worked there for 15 years as head of property, engineering, underwriting and risk management. This presentation is divided into various sections and we will be covering policy coverage, exclusions, eligibility criteria, understanding of basic terms like your gross profit, gross loss, net profit, and other fundamental accounting things. We will also understand the different methods of calculation of gross profit, how to fix the sum insured, interruption period, indemnity period, and application of underinsurance and deductible. We will also understand various forms of turnover to find out the loss, rate of gross profit, and other policy extensions. At last, we will also see how to compute BI loss along with working examples. Basically, this presentation is designed for beginners as well as for those who are dealing with business interruption policy on their day-to-day basis. It will also help students who are appearing for associate examination or preparing for various competitive examination with this subject. Now we will understand the basic concept of business interruption policy. Now if you see what it covers, in case of physical loss of or damage to the property which is insured under standard fire policy, if it causes total or partial stoppage of the production activity and if it leads to reduction in sales turnover, then on account of this, any loss of gross profit suffered by the client during the interruption period becomes payable. This payment is, of course, subject to one basic condition that the loss should be admissible under material damage policy, and this condition is known as material damage proviso. Now, understanding the flow of events, there has to be a material damage policy, basic fundamental. Then there should be an indemnifiable loss. That means a loss which is payable under material damage policy. Then it should lead to interruption in production process. This is a must. Either partial interruption or total stoppage of production. It should lead to interruption of production. Then it should lead to reduction in sales turnover. It should not so happen that interruption is there, but there is no reduction in sales turnover. That should be there to get a loss. And finally, if everything complies with the requirements, if there is a reduction in sales turnover, then we pay ultimately whatever is the gross profit suffered by the client during the indemnity period. Who can take this policy? Eligibility criteria. Now we see these are the three criteria. Anybody who is having a fire material damage policy in force can take PI policy. Another condition is the unit, the risk, should be earning gross profits. And another situation is if the unit has suffered net loss, then also it can be covered so long as it does not suffer gross loss. Gross loss situation is something which cannot be insured under BI policy. And this gross loss situation will arise when the turnover of the risk is not sufficient to meet out the manufacturing expenses. That means manufacturing expenses are higher than sales turnover. In that situation, BI policy cannot be given. What we pay? If the loss is admissible under material damage policy, then only we pay, and we pay two things. Number one, loss of gross profit suffered during the indemnity period, and plus increased cost of working if it is incurred to avoid business interruption loss. So we will see in subsequent slides what is increased cost of working and what is the upper limit to claim it. Now let us discuss what is interruption period. It is the period which starts from the date of loss and it ends when the business achieves the same production level where it was prior to the loss at the insured premises. And what is indemnity period? It is defined as the period beginning with the date of loss, that is occurrence of damage, and ending not later than this 3 months, 6 months, 9 months, some period has to be inserted here before issuing the policy as defined in the policy, or the date when the business resumes pre-accident levels of production, whichever is earlier. That means either this date or the resumption of production same levels, whichever is earlier, that is the end of indemnity period. Now let us understand the concepts of indemnity period. Here, if you see, this is the policy period. It starts 1st of January, ends 31st of December. And if the date of loss is 1st of March and it recovers on 15th of Feb, then of course this is the interruption period during which there was no production. Now on 15th of Feb we see business comes back to full stream. Now there are two situations. One is longer indemnity period. That means the insured has selected an indemnity period of 15 months. That means the entire loss during the interruption period shall be paid under this policy. But on the contrary, if the indemnity period selected is only 9 months, in that situation, the insured will suffer and he will be paid only for this indemnity period. He will not get full loss of interruption period. What are the factors which will affect indemnity period? These are the few things which has to be kept in mind before deciding the length of indemnity period. This is the time required to repair the affected building or the machinery. Availability of alternative premises. This is very important, where the business can be shifted to some other unit. In that situation, if the alternate premises is easily available, in that case the length of indemnity period can be reduced. Then what is the lead time for replacement or repair of the machinery? Of course, critical machinery. Then what are the possibilities of repairs within the same city, town or country? Then what is the availability of raw material and labor? These are the factors based on which the insured must decide the selection, must do the selection of indemnity period. Let us now see some of the important definitions. These are known as standing charges or fixed expenses. What are these charges? These are the expenses which remain unchanged irrespective of production levels. That means they do not vary. Okay, whether there is a production or not, these expenses will remain constant. Like your rent, taxes, minimum demand charge, power, water charges, repair maintenance, depreciation, interest, royalty, office and administrative expenses, etc. These are the expenses which has got no correlation with the production. Now other type of expenses are variable expenses. They are also known as manufacturing cost. They vary with the production level. That means no production, no expense, such as your raw material cost, packing material, stores, then your direct expenses like your power, fuel, freight, discount, handling charges, etc. They vary with the production level. Third category is your semi-variable expenses. These are the expenses which can be categorized under both categories. That means they may fall under half of them, they may fall under fixed and remaining can be variable. Like your power. Say for example, this power which is utilized under production block, that is a variable expense, and the power which is utilized under office and other places, that is a fixed expense. Same is the case with labor cost. The production labor is your variable and the office labor is your fixed expenses. Similarly, maintenance expenses. So these expenses are to be apportioned properly before computing the gross profit. Now what is gross profit? Let us understand this particular term. This is the amount by which the sales turnover exceeds the manufacturing cost. That means if the sales turnover is 100 and the manufacturing cost is 70, so the difference, the gap is your gross profit. More is the sales turnover, more would be the gross profit. What is gross loss? It is the reverse of gross profit. That means the sales turnover is not sufficient to meet out the manufacturing cost. Then the shortfall is known as gross profit. So as we have already discussed, LOP policy should not be given in this situation. Here is the example. Here if you see, the manufacturing cost is higher than sales turnover. So the example would be, if you take manufacturing cost is 100 and sales turnover is 70, then in that situation the gross loss suffered by the client would be 30. These are the basic concepts. Let us see. The turnover, sales turnover, is the sum total of these three components. They are net profit, fixed cost and variable cost. Now if you see the diagram, you will find the same thing. The sales turnover is the sum total of net profit, fixed cost and variable cost. In this diagram you can see. The other formula which comes from this diagram, if you see, the gross profit is your turnover minus variable cost. Now if you see, this is the gross profit. So this gross profit, how can you arrive? If you reduce the variable cost from the sales turnover, the remainder is gross profit. This method is known as difference method. Then another way of computing gross profit is your sum total of these two, net profit plus fixed charges, that is standing charges. So here is the formula. The standing charges plus net profit is your gross profit. And gross profit is the same whether you compute by difference method or you compute by addition method. Another situation is your gross profit can be computed by deducting the net loss from the standing charges. In the event of a net loss situation, standing charges are more, then gross profit can be computed by reducing net loss from the standing charges. There is the situation where the client would demand coverage of policy based on standing charges alone. Let us see this on the next slide. Now let us understand the funda of net profit and net loss. Now you see, whenever the gross profit is higher than standing charges, then that means the unit is generating net profit. So if the gross profit is 30 and the fixed expenses or the standing charges are 20, then the remainder, the difference, is 10 crores, which is the net profit. So the formula becomes gross profit is equal to standing charges plus net profit. Gross profit is standing charges plus net profit. Now let us see what is net loss. If the standing charges are more than the gross profit, that means the standing charges are 30 and gross profit is 20. So instead of net profit, the unit will suffer net loss of 10. So in this situation, the formula to compute gross profit would be standing charges minus net loss. So here's the formula. What should be the sum insured? Basically, it should represent the estimated annual gross profit duly adjusted as per the trend and indemnity period of the policy. So before deciding the sum insured, insured has to find out the estimated annual gross profit of the policy, which is to be adjusted based on the trend and indemnity period. How to calculate annual gross profit? Addition method, we have already explained. And this says there are two ways of calculating. One is gross profit is net profit plus standing charges, addition method. And in case, this is the addition method. In case the risk is suffering with net loss, then standing charges minus net loss. That gives you the gross profit. And under both the situations, standing charges alone should not be covered, because in this situation, if you cover standing charges alone, that means you are paying more than the indemnity. You are paying more than the gross profit. The other method is difference method, which says the gross profit can be calculated by this formula: turnover minus variable expenses plus increase in inventory of finished goods. So whatever, if the end of the year, the inventory of finished good is on the higher side, then it is to be added. Or the other way around, we can see the same formula, like your you add the closing stock to the turnover and you add the opening stock to the variable expenses, and the difference gives you the value of gross profit. Now the question comes, how to decide the policy sum insured? As per the fire tariff, for policies with 12 months indemnity period or less, the sum insured must represent the annual gross profit of the industry. Then for the policies where the indemnity period is more than 12 months, maximum it can go up to 36 months. The sum insured has to be increased proportionately. That means for 18 months, it should be 1.5 times of the annual gross profit. For 24 months, 2 times, 30 months, 2.5 times, and so on. So for 3 years, it should be 36 months. Now, let us see. There are 3 types of turnovers. We will discuss one by one. One is your financial year turnover, and this is very simple. This is defined as the turnover during the entire financial year of the risk. So whatever turnover is done during the 12 months financial year, that is your financial year turnover. Another is annual turnover. Annual turnover is defined as the turnover during the 12 months period immediately before the date of loss. This is used in computing the adequacy of sum insured. And the third one is standard turnover. This turnover, the turnover generated during the period in the previous financial year before the date of loss, which corresponds with the indemnity period, is your standard turnover. And all these terms, they look confusing, but from the next diagram we will understand in a better way. Now some of the terms we will have to understand. IP is your indemnity period. STO is used to define the standard turnover. ATO is your annual turnover, and FYTO is your financial year turnover. Now let us see the basic diagram. Now here is an example of a 17-18 policy. This was the financial year turnover. Then the policy is renewed for 18-19 period, and here is the date of loss. And this is the date of recovery. That means from date of loss till date of recovery, this is the period of indemnity period, for which the loss shall be payable. Now, from date of loss, if you go 12 months back as per the definition, so whatever is the turnover generated during these 12 months period, that gives you the annual turnover. This is your financial year turnover, and this is your annual turnover. Now, if you see, if the annual turnover figure is more than financial year turnover, what does it mean? This clearly gives an indication that the risk is growing. Insured is growing at a certain pace. And let us now understand what is the standard turnover. So this is the indemnity period. Now what we have said, you go in the previous financial year and find out the turnover generated by the insured for the period which corresponds to the indemnity period. So here is this period. This corresponds to indemnity period. Say for example, it is from 1st of April to 30th of June. So you go in the previous financial year and find out what was the turnover generated by the insured from 1st of April till 30th of June. And that gives you the figure of the standard turnover. Now, as I have explained, the business growth in the business can be found out by this formula, annual turnover minus financial year turnover and divided by financial year turnover multiplied by 100. This gives you the growth. It can be 10%, 15%, 20%, 25% depending upon the circumstances. And on the contrary, if the annual turnover is lower than financial year turnover, that means it is a negative growth. Company is degrowing, and this degrowth or positive growth, negative growth or positive growth has to be adjusted while computing the loss. Now rate of gross profit. Rate of gross profit earned on the turnover during the financial year immediately before the date of loss. That means this is simple. Gross profit divided by financial year turnover. This gives you the rate of gross profit. Say for example, in a financial year turnover of 100 crores, if the risk generates 20 crores gross profit, that means the rate of gross profit is 20%. Now this is the most important clause, strengths and adjustment clause for computation of loss. Let us see what it says. It says that while computing the figures of standard turnover, annual turnover and rate of gross profit, some adjustments shall have to be made for the trend of the business or special circumstances which affect the business, so that adjusted figures so arrived represent the true value as nearly as practicably possible. That means whatever you are computing based on previous year financial year, this standard turnover is again, this correspond to previous year financial year. Rate of gross profit is also based on a previous year financial year. Annual turnover is again, we are looking at the 12 months period prior to date of loss. So these figures have to be adjusted either in a positive way or negative way. And some special circumstances that has to be looked into, and the surveyor has to adjust these figures and find out the revised value, adjusted value for computation of loss, so that the correct indemnity is payable to the insured. Now we have already discussed increased cost of working, we call it ICOW. This is the additional expenditure reasonably and necessarily incurred with the sole intention to avoid or minimize the reduction in turnover and to mitigate the loss of gross profit. Now this is very important. There are two things. One is the additional expenditure when it is to be done after the loss. That means during the indemnity period, if the insured incurs some additional cost which is reasonably and necessarily incurred. What is the sole intention? With the sole intention of avoiding or minimizing the reduction of turnover. That means indirectly you are incurring some expenses to mitigate loss of GP. Then only it is paid. Increased cost of working is payable. But it is subject to a limit, and that limit is known as economy limit, and it is limited to loss of GP thereby avoided. And the formula is rate of gross profit multiplied by reduction in turnover thereby avoided. So by this way you can find out to what extent you can pay the increased cost of working. It can happen that insured incurs a sum of rupees 10 crores as increased cost of working with the hope of reducing the turnover, but finally when the loss is computed, surveyor may found, this can be a possibility, that the loss of gross profit avoided was hardly 6 crores. In that situation, the company would pay maximum 6 crores instead of 10 crores. Here is the example of increased cost of working. Like your bonus payment to contractor for early completion of building repairs and for quick delivery of new machineries. Then your additional cost to competent contractor other than lowest tenderer. Then additional payment to machinery supplier for giving priority over other orders. Hiring of generator in case of damage to transformer. This is the most common way of incurring the increased cost of working. In majority of the cases, in case there is a breakdown of transformer, then the unit goes for hiring a generator, and the expenses of generator to run the production, to run the show. That means indirectly insured is avoiding the reduction in turnover that gets paid. Then another example is your additional cost in buying alternate equipment more readily available than that destroyed in accident. How it is paid? Because if he waits for the same equipment, it may take more time. But our alternate equipment, although it is slightly higher in cost, but still the difference in cost can be paid as increased cost of working. Another example is additional overtime payment to outside contractors or to own staff for speedy resumption of production activity. That means by paying additional payment if the production activity is completed fast. That means loss of gross profit is avoided, and in that situation, such expenses can be paid. Now this is the end of part 1 of this video, and now in part 2 we will discuss about extensions, which include your contingent, business interruption and other extensions of the policy. Thank you.